What are accounting policies? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. What are accounting policies? Well, accounting policies are something that you will see in your company accounts, and they are basically the process, the procedure that you as the directors of the company have determined to bring your accounts together. Now, generally these will start with the fact that they're being prepared under the appropriate accounting standard. So this may be the FRS 105 micro company standard or the FRS 102 small company standards. So you've got a few different options there, but these accounting standards will dictate what options you have available to you, and then depending on those options that you have available to you, that will then determine what your accounting standards are. For a property company, the type of accounting policies that we would expect to see are going to be things in line with valuation, investment properties, and things like deferred tax are probably going to be some of the key ones that we have noted. Now, generally you will always find that there's some sort of tax accounting standard which just details how things are fit together. So let me show you some examples. We'll talk through those examples so you can understand what you will be seeing in your accounts, and then hopefully that will give you an idea of what you're expecting to see in your company accounts and potentially the options that you will have available to you. So let's jump into some example policies. So here we have our notes to the financial statements, and these are starting off with our statutory information, which is basically the key data that we are required to disclose in a set of accounts. So they cover our company name, it's a private company, it's limited by shares, and it's registered in the appropriate country, which in this case is England and Wales. We've then got the company's registration number and registered office address, which for this one there's a separate page, otherwise they would be incorporated here into the statutory information note. We then have details of what the presentation currency is, which for most of us is going to be pound sterling based on the people who are likely watching this video. We then move into our accounting policies, which are basically looking after how have we actually put together a set of accounts and what are the policies we've operated. Now, the first one that you will find in pretty much all sets of accounts is going to be the basis of preparing the financial statements, as this is basically going to determine what accounting standards have been used. Now, as we can see on this one, we've got Financial Reporting Standard 102, the financial reporting standard applicable in the UK and Republic of Ireland, and we're also including the provisions of Section 1A, small entities, which means these are a small company set of accounts, so they've got more disclosure than the micro set of accounts, but they're not the full company accounts where there is any and every accounting policy and description and disclosure. So the final part of this one is then the financial statements have been prepared under the historical cost convention as modified by the revaluation of certain assets, which is basically telling us we're showing everything at the cost that we've paid. However, there is the scope that we've revalued certain of the different assets in the accounts, and we've accounted for them in that way. So this is always going to be the point where it tells you how the accounts have been set up, and that will tell us, or an accountant anyway, exactly what standards that they are working to when they have been completing the accounts. Our next normal note that we would tend to see is our turnover accounting policy. And the reason for our accounting turnover policy is because we want to know how has that turnover figure been created. Now, in this example, we've got turnover is measured at fair value of the consideration received or receivable, excluding discounts, rebates, value-added tax, and other sales taxes. So it's basically telling us how that number has been created. If you have a different style of income, it may be you receive income in the next 12, 18, 24 months, and actually you're recognizing your income at the point of receipt, or you may be spreading that income over the period that you're actually delivering the service. Now, if that's the case, then you may need to vary that accounting policy to basically explain how you are actually recognising that income. It may be that you do returns, so actually you don't just want to show you receive your income. You may say income is only recognised at the point that it has been confirmed that receipt is non-refundable, for example. So there is different discrepancies, and if you're not sure what you should be putting in, that's the question to speak to your accountant and potentially look at other sets of accounts to see what other people are putting in, to see what is going to be right for you and your company. Now, our next note is about our tangible fixed assets in our example today. And in our tangible fixed assets, this is really telling us what's depreciation, what we're doing with those assets, and how we're spreading the cost of them over whatever period of time it may be over their useful life. So we can see here we've got our depreciation is provided at our annual rates in order to write off each asset over its estimated useful life. So for example, we might say a computer's over 3 years, so we'd have it shown with the computer expenses at 33% on straight line basis. Here we've got some examples of plant and machinery and fixed fixtures and fittings at 25% and 20% on reducing balance. If you want to know more about the depreciation side of things, check out the video on the channel which explains a bit more about the different methods of depreciating things and how it fits together. But this is in essence where we're disclosing how we are dealing with those assets and what sort of write-off period we are looking at. Moving on to our investment property, which as a property channel you would expect us to be talking about investment property, and our investment property is shown at the most recent valuation. So in this set of accounts we are showing them at valuation rates rather than historical cost rates, and this is a difference in what you decide to do with your accounting policies. So in this one we have to tell the reader of the accounts how we're dealing with those revaluations, because if we bought it for 100,000 it's now worth 200, what's happening with that 100,000 discrepancy? Because we're going to increase it to 200,000 on our balance sheet, but where's that other 100,000 going? So on that basis we are going to share in here any aggregate surplus or deficit, so increase or decrease, arising from changes in fair value, which just means the market rate at the year-end accounts, is recognised in profit and loss. So that means it's going into our income statement or profit and loss account, so it will show as a profit or loss in that period in our main kind of part of the company accounts. Obviously here we'll determine what you are doing, how you are running it, and you may need to expand or you can keep it quite simple than the accounting policy, depending on how simple or complex your business is. It may be you have both some freehold property, some property you use in the business, and you have some investment property. So you might need two notes to just differentiate between the two different types of property that you have. Now let us move on to some of the final notes that I'm just showing you today to give you an idea of some of the accounting policies that you may see. And the next one is to do with taxation. And this is really disclosing how taxation is being dealt with. So for this we've got taxation for the year comprises of current and deferred tax, so the one you've got to pay, and the make-believe tax. Check out the video on deferred tax if you want to understand more about the make-believe tax. Tax is then recognised in our income statement or our profit and loss account to the extent that it relates to items recognised. So here we're just telling the reader exactly how we're dealing with it. We've got current or deferred tax assets and liabilities are not discounted. So with money, hopefully you may have an awareness of the time value of money, how over time the value of money decreases in value. So on that basis we just need to take account of that sometimes. And here we are saying we have not taken account of that. We've actually just included it at the value that it is as of today. Our final part of this note is just saying that current tax is recognised at the amount of tax payable using current rates that have been enacted or substantially enacted by the statement of financial position date. So this really just means that we're using the tax rates that we know that government has put in place and that government has got in line that will be happening, rather than potential rates that may happen or may not happen, but they've actually gone through Parliament, they've gone through the House of Lords, they've gone through all the appropriate phases that they need to go through, so we know that they are factual. This then leads us on to our deferred tax note, which goes into a little bit more detail about how the deferred tax has been dealt with. And this is really all about timing differences. And when we've got a revaluation, for example, and we've gone up in 100,000 in value, we're going to have some tax on that in the future. So we've kind of got to recognise it today on the potential that in the future we will pay some tax. So on that premise, we now need to kind of just tell the reader how we're going to deal with that and what rates we're going to use. So this is where kind of the paragraph stating it's measured at the tax rates and laws that have been enacted or substantially enacted, and where we're expecting these actual things to apply. So for certain things we might ignore them, but for others we need to definitely include them. And this is what your accountant is likely doing in the background, but this is just something to be aware of, and we need to put it in an accounting policy to explain to the reader of the account how it's been dealt with. The final paragraph in this policy is about unrelieved tax losses and other deferred tax assets, where we're only actually going to show them to the extent that it's probable, which in essence means if we're not going to get the money back, or if we're not going to have to pay the tax, we're not going to be disclosing in the accounts or including that as an expense or an income in the accounts. So again, it's just giving the picture of how we're going to be dealing with different things to ensure that we are covering all the bases. That's all of the accounting policies that we have here. The other point just to note here, we have got our going concern note, which is basically because this set of accounts was insolvent, showing a negative balance sheet, we just needed to state that the directors are going to confirm that they will support the company for the foreseeable future, which is just giving credibility that the company is not going to fold, it's not going to flop going forward, it's going to continue, and the directors will be putting money in if necessary to make sure the company does keep going. So that hopefully gives you an idea of some of the different accounting policies that may be out there. And I think the key thing here is to note that these are some of the ones as an example, but depending what you do in your company accounts, you may need more or less. For example, if you have a company with several different types of income sources, you may need to have more than one line for your turnover accounting policy. You might need to have 3 separate lines explaining the 3 different types of income that the company is receiving to make sure that the reader understands how the company is generating that turnover figure. So this is a starting point and hopefully gives you an idea of what you may be able to see. But if you look at any set of accounts, you'll see different accounting policies, and hopefully that will give you an idea of what you need to be including in your company accounts. As you can see, these are some of the ones that you will hopefully be seeing in your company accounts. And if you're not seeing it in your company accounts, you may want to ask the question of your accountant, why have I not got this accounting policy, just to make sure that your accounting policies are complete. Under accounting standards, we're required to disclose our accounting policies in any small company accounts and detail how we have pulled things together. In the micro company accounts, we don't have to disclose our accounting policies, but they will be there behind the scenes because they will have dictated how you pull your set of company accounts together. You'll be able to see what yours are by looking at your company accounts, and these will be available from what your accountant will have sent to you and should appear on Companies House as well. So get reading, have a look at what you have got so you can just understand what your accounting policies are, which you will have hopefully agreed with your accountant or they will have put through for you on the basis of standard convention of that type of company. But these are something you can have a conversation with them about if it's something you want to make any tweaks, assuming that that is in line with what accounting standards allow us to do. Hopefully today you've discovered what accounting policies are and how they fit together with your company accounts. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. less tax